Welcome to the world where debt is not a dirty word, but a powerful tool for the wealthy. While most of us view debt as a burden, the rich see it as an opportunity. They use it to their advantage, leveraging it to make even more money. In this video, we will explore the top 5 ways the rich use debt to make money and how you can do the same. From real estate investments to business acquisitions, get ready to discover the secrets of the wealthy and how they use debt to build their fortunes. Number 5. Margin investing. In the world of finance, margin investing has a long and storied history. The concept of buying stocks on margin dates back to the early 20th century when the stock market was first becoming accessible to average investors. At the time, margin accounts were relatively easy to open, and investors could borrow large amounts of money to invest in the stock market. Investing on margin can be a lucrative strategy for experienced investors seeking higher returns. However, it also involves higher risk as the potential for both gains and losses can be amplified. When you open a margin account, your broker may charge you an interest rate on the amount of money you borrow, which could impact your overall profit margin. Before diving into margin investing, it's important to have a solid understanding of the risks and to have a plan in place for managing them. It's crucial to have a well-diversified portfolio and not to over-leverage your investments. Over-leveraging can lead to substantial losses and make it harder to recover from a margin call. Additionally, it's important to keep a close eye on your margin account and monitor your positions regularly. If the value of your stocks declines too rapidly, it could trigger a margin call and you may need to take action to prevent further losses. One way to mitigate the risk of investing in margin is to use stop-loss orders. These orders can automatically trigger a sale of your stock if its value falls below a certain threshold, limiting your potential losses. Number 4. Short selling. Selling short is a unique trading strategy that allows you to profit from the decline in the price of a stock. By selling high and buying low, you are essentially betting against the success of the company whose stock you are shorting. It's a bold and risky move, but when done correctly, it can pay off big time. To get started, you'll need a margin account with your broker. This is a type of account that allows you to borrow stocks to sell on the market. When you borrow the stock and sell it, you are opening a short position. You'll then need to buy the stock back at a lower price to close the position and make a profit. But be warned, selling short is not for the faint of heart. It requires a deep understanding of the market and a keen eye for spotting opportunities. You'll need to research and analyze companies to identify potential targets for shorting. And because you're betting against the success of a company, there's always a risk that the stock could rise, causing you to lose money. However, selling short can be a powerful tool in your investment arsenal. It can be especially useful during market downturns or in industries that are facing challenges. Plus, it allows you to make money in a falling market, which is something that traditional investing strategies can't do. So, if you are ready to take a bold step and try your hand at selling short, buckle up and get ready for an exciting ride in the world of trading. With a margin account and a solid understanding of the market, you could be on your way to profiting from the decline of stocks in no time. Number 3. Leverage in real estate investing. Real estate investing is a popular way of building wealth, and leveraging is a powerful tool that investors can use to increase their returns. Leverage involves using borrowed funds to invest in a property with the expectation of generating a higher return than the cost of the borrowed funds. Imagine you are a real estate investor who wants to build a successful property portfolio. One of the most effective ways to do this is by using debt to buy property and then renting it out. Here's how it works. Let's say you have $100,000 in savings and you want to invest in real estate. You find a property worth $200,000 that you believe will generate a rental income of $2,000 per month. You could use your $100,000 in savings to buy the property outright, but that would limit your ability to invest in other properties. Instead, you decide to take a loan for $150,000 to buy the property, using your $100,000 as a down payment. With a rental income of $2,000 per month, you can use that income to pay off the loan and still have a positive cash flow. By using debt, the rich maximize their returns and grow their real estate portfolio more quickly. With the rental income generated from one property, they can reinvest it into buying another property and continue to build their portfolio. Of course, there are risks associated with taking on debt, such as the potential for interest rates to rise or for the property to not generate the expected rental income. However, with the solid investment strategy and a keen eye for selecting the right properties, using debt to invest in real estate can be a smart way to build wealth over time. Number 2. Private equity investments. Have you ever heard of private equity firms? They're these really cool companies that invest in and acquire ownership stakes in private companies. But that's just the beginning. They then take those companies and improve them with the goal of generating a high return on investment. And trust me, these guys know how to spot a good investment opportunity. But here's the thing, it takes more than just investing money to turn a profit. That's why private equity firms are experts at finding inefficiencies in a company and finding ways to fix them. Once they've acquired a company, they get to work implementing changes that will make it more efficient and profitable. Think investing in new technology, hiring new management, or restructuring the company's operations to cut costs. It's all about increasing the company's value and ultimately selling it for a higher price in the future. Now, you might be wondering, why use debt to acquire a company in the first place? Well, imagine you are the CEO of a small struggling company. You've been working tirelessly to grow the business, but with limited resources, it's just not happening. Then out of nowhere, a private equity firm approaches you with an offer to acquire your company. They explain that they'll use debt to finance the acquisition, which will give them control over the company and access to its cash flow. At first, you're skeptical. You are not sure if you want to sell your company or give up control to an outside investor. But then the private equity firm shows you their proven track record of turning around struggling companies and increasing their value. Suddenly, it all seems like a no-brainer. You agree to the offer, and the private equity firm acquires your company. They quickly get to work implementing changes that will increase efficiency and profitability. And guess what? It works! Your company is growing faster than it has ever before, and you are able to take a step back and focus on other areas of your life. Meanwhile, the private equity firm is earning a higher return on their investment thanks to the leverage they use to acquire your company. And this is how the rich operate. They use debt to acquire companies via private equity firms and earn a higher return on their investment. It can be a risky strategy, but if done right, it's a powerful tool that can help struggling companies like yours grow and thrive. Number 1. Business expansion. Have you ever wondered how some businesses are able to expand and grow so quickly? One way is by using debt to finance their growth. That's right, taking on debt can actually be a smart way to invest in your business and achieve your growth goals. Expanding a business can be both exciting and nerve-wracking. On one hand, you have the potential to increase revenue and reach new customers. On the other hand, taking on debt to fund expansion can be a risky move. But what if it's the right strategy for your business? Let's take a closer look at how debt can be used to expand a business. Imagine you're the owner of a small business that has been doing well. You have a loyal customer base and a strong reputation in the industry. However, you feel like you've hit a plateau in terms of revenue and growth. You want to take your business to the next level, but you don't have the funds to do so. This is where debt can come in handy. By taking out a loan, you can invest in your business to help it grow. For example, you could use the loan to hire more employees, purchase new equipment, or open a new location. These investments can help you increase your production capacity, attract new customers, and ultimately generate more revenue. But before you jump in and take on debt, it's important to have a solid plan in place. You need to assess the potential risks and rewards of the expansion, understand the terms and conditions of the loan, and make sure your business has the capacity to repay the loan. Taking on too much debt can put your business at risk, so it's important to have a plan and be prepared for those risks. It can help you grow your business, attract customers, and increase profits. So there you have it, 5 ways the rich use debt to make money. We hope you found these strategies useful and insightful. Now, what do you think? Would you consider using debt to make money? Do you have any other strategies for using debt to grow your wealth? Share your thoughts and experiences in the comments below. And if you found this video helpful, be sure to give it a thumbs up and subscribe to our channel for more informative content like this. Don't forget to hit the notification bell so you never miss a video. Thank you for watching, and we'll see you in the next one.